Today's crypto story is not just price, it is power. It is permits, it is weak demand hiding under a green candle, and it is one governance attack that looks like somebody bought the keys to the treasury, used them, and then walked away with the bag. So the headline for today is simple. Crypto is splitting into two markets. One side is still the coin market, everyone watches every morning. Bitcoin, Ethereum, Solana, the ETF flows, the leverage, the "are we back?" candles, the panic candles, the same emotional roller coaster with different numbers. But the other side is becoming actual infrastructure, power contracts, data centers, licenses, treasury management, regulation. The boring stuff that does not always look viral, but decides who survives when the hype cools off. And the biggest example today is TeraWulf. The company announced a 20-year lease with Anthropic at its Justified Data campus in Kentucky. According to TeraWulf, that lease is expected to generate about $19 billion of contracted revenue over the initial term. $19 billion! That is not a random memecoin candle. That is not a 3-day liquidity squeeze. That is a power and infrastructure business trying to turn energy capacity into long-term AI revenue. And this matters for crypto because a lot of the old mining story was built around one question: can you mine Bitcoin cheaper than the market values the coin? But the AI data center story changes the question. Now it becomes, if you already control power, land, cooling, grid connections, and industrial infrastructure, is Bitcoin mining really the highest value use of that asset, or can an AI customer pay more predictable money for the same physical foundation? That is why this is more important than just one company's press release. It shows the pressure on miners and infrastructure operators. Mining-only economics are volatile. The coin price moves, difficulty moves, hardware ages, energy costs move. But contracted AI infrastructure revenue can look cleaner, longer term, and easier for traditional investors to understand. That does not mean every miner magically becomes an AI winner. This is not buy every mining stock because AI. The hard part is execution. You need power, you need build-out, you need customers, you need financing. You need to actually deliver capacity, not just put AI in a presentation deck and hope the chart goes vertical, but the direction is clear. The crypto infrastructure companies that own scarce power assets are trying to become more than miners. And that is the first big theme today. The market is slowly learning that the most valuable thing in crypto might not always be the coin on the screen. It might be the boring physical infrastructure behind it. Now, the second story is Coinbase in the UK. Coinbase secured UK authorization that allows it to offer traditional investments alongside crypto. The reports say institutional traders can access perpetual futures, and UK retail customers can start with equities access. The important part is not just Coinbase got a license. The important part is that the lines are blurring. Crypto exchanges do not want to be only places where people buy tokens. The bigger ambition is to become full financial platforms. Crypto, derivatives, stocks, stablecoins, payments, custody, and institutional access under one roof. That is why regulation matters so much. People online often talk like regulation is either a total ban or instant approval. In reality, the valuable zone is usually in the middle: legal access, clear permissions, and enough trust that larger customers can actually use the platform without feeling like they are standing inside a casino during a fire drill. For Coinbase, the UK authorization is part of that bigger push for users. It means crypto apps may keep moving closer to normal brokerage apps. For the industry, it means the winners may be the companies that can survive both sides: crypto-native speed and traditional finance compliance. Again, this is not a hype headline. It is a Rails headline, and Rails are boring until everybody has to use them. Now, let's talk about Bitcoin, because this is where the mood gets weird. At the source check today, Bitcoin was around $63,000, Ethereum was around $1,767, and Solana was around $80. So yes, the market was green on the day. But the clean question is not, is the candle green? The clean question is, who is actually buying, and is there enough demand under the move? CoinDesk reported that Bitcoin's July gains may be fleeting because US demand still looks weak. They also reported that Bitcoin had retreated from a 2-week high, around $64,500, while declining open interest and weak spot demand raised questions about the rally's staying power. That is the part a lot of people miss. A price can bounce without the market becoming healthy. A candle can go up because shorts unwind, liquidity shifts, macro fear relaxes, or traders chase momentum for 2 sessions. But if spot demand is not convincing, and if leverage is not building in a healthy way, the move can become fragile fast. This is why Bitcoin is up, and Bitcoin still looks shaky can both be true. Green does not automatically mean strong, it just means price is higher than it was. Strength is a deeper question. For this channel, the point is not to predict the next tick, the point is to separate signal from cope. If Bitcoin keeps climbing with improving demand, improving ETF flows, and healthier market structure, that is a different story. But if price floats up while demand remains weak, then the market is basically walking across a bridge and hoping nobody checks the cracks underneath. So that is the third theme today. Do not confuse a bounce with confirmation. Now, the most insane story of the day is BONK. CoinDesk reported that BONK faced a $20 million treasury drain after an attacker spent about $4 million to pass a malicious proposal. And the mechanism is the part that matters. According to the report, the attacker bought enough tokens to pass a governance proposal that sent the group's holdings to a wallet they controlled, then began selling. That is not just a hack in the normal movie sense. That is governance turning into an attack surface. In normal security stories, people usually think about private keys, smart contract bugs, bridges, wallets, signatures, and code mistakes. But governance has its own failure mode. If voting power can be bought cheaply enough, then the treasury itself becomes the prize. Imagine a bank where the vault door opens if enough people press a voting button. Now, imagine someone can buy enough voting buttons. That is the risk. And this is why DAO governance is not automatically decentralization magic. It depends on token distribution, proposal rules, voting delays, quorum, emergency controls, treasury safeguards, and whether the system assumes voters are always honest and paying attention. Because in a fast market, attention is expensive. Attackers know that. They do not need every voter to agree with them. Sometimes they only need enough sleepy voters, enough cheap liquidity, and enough time to push one ugly proposal through. That is the fourth theme today. Crypto security is not only code security, it is also governance security. And if a project has a treasury, a token, and loose controls, then the question is not just can the contract be hacked. The question is also can the rules be used against the project. Now put all of today's stories together and the market looks very different. TeraWulf shows crypto infrastructure moving toward long-term AI power deals. Coinbase shows crypto platforms moving toward regulated traditional finance access. Bitcoin shows price can bounce while demand still looks questionable, and BONK shows governance can become a financial attack vector if the incentives are broken. That is why I think today's real story is not bullish or bearish in the lazy sense, it is selective. The market is getting more selective about what deserves value, power assets, maybe regulated rails, maybe real demand under a rally. Prove it. Loose governance with a treasury sitting behind a vote, that is not a feature, that is a target. So if you're watching crypto right now, do not only watch the candle, watch what the companies are becoming, watch where the revenue is contracted, watch who is getting licensed, watch whether demand is real, and watch whether a project's governance is actually protecting the treasury or just decorating the front door while the back door is wide open. That is the roundup for today. Nothing here is financial advice. This is crypto news and market structure, and the real signal today is that crypto is growing up in the most uncomfortable way possible. Less magic, more infrastructure, more rules, and much less room for sloppy security.